Welcome, everybody. Thank you for joining us this week to talk about a subject that is near and dear to our nerdy kind of hearts. Um, I wouldn't say that, well, this is probably one of the favorite presentations we give because it goes so into the weeds and something that Pete and I have worked on for many of years. We are engineers by trade, and we have built software around everything about running a Delaware C corporation for high growth startups. We've lived and breathed the churning, the reality, the messy reality into actually sensical bits. And in the process, learned so much about what it takes to build a business, to collaborate, to obey the law, to raise funds from investors, and all the intricacies and nitty-gritties around it. And we're really excited to share it. So before we jump into this, I'm going to give you an introduction of both who we are. Pete, Gus CEO, introduce yourself, a little background.
Yeah, my name's Peter Swan. I've been CEO at Gust for, 4 years now. Been working with Nash at Gust for over a decade now, on all things to make it easier to start, run, and fund a company. Um, and yeah, software engineer by trade, and here we are.
Here we are. My background is similarly similar. I'm also an engineer by trade. Pete and I have worked here over a decade, but we kind of I went into sort of people and operations while he handled the architecture, and then we came together 4 or 5 years ago to really kind of make this our own, with obviously Gust's founder, David S. Rose, and a strong amount of the team behind us. So while everybody's in here and we're setting up, feel free to throw where you're coming from in the chat. The chat should be open for all, and throughout this, throw any questions at us. We've given ourselves space today to dig into the fundamental concepts. If you've been to some of our events, we cover everything from the pre-seed funding, what you need to prepare, how to follow on and keep people up to date. But we'll have some extra space to just dig into the intricacies of formation. And without further, I'm going to share my screen in 1 second. Pete, any caveats we want to give?
No caveats, but we will send out the recording and the deck afterwards. I'm sure many will still ask, but that will come to you within 24 hours.
Excellent. And here we go. And voila. Can you see my screen?
Good to go.
Excellent. All right. So we've titled today's presentation, Start Formation, Equity, and Early Legal, everything you need to know how to avoid 10 to 15K in corporate cleanup. Caveat, that might even be more. A lot of times as founders just kind of scrap in the early days and make decisions and do whatever it takes. They can heap themselves up with a bunch of, nasty cleanup should things go well. And the last thing you want to do is land a really good deal, land an investor, get a distribution opportunity, only be met in the face of legal bills, fees, attorney things, and whatnot. So we're going to go through all that in detail. So first up, why would I even need a legal entity? We're assuming the audience here is all founders of startups. Startups maybe not interested in just raising funds, but building a business that's bigger than just themselves, that could employ people, that could grow and expand, and tackle significant markets. We're not talking about single locations. But when it comes to building a company like that, there's three aspects around why you even want legal entity. So in the United States, if you just start doing business, you are a sole proprietorship. You don't have to file anything. You don't have to go to any courthouse or anything like that. You're just assumed under the laws of the land that you're a sole proprietorship. So if you're a handyman or if you're just, selling consulting services or anything like that, you already have a business. However, the downside to that is while doing business, some or all of you might know, like sometimes people disagree, or sometimes things don't go as planned, or sometimes accidents happen, and somebody wants to hold somebody else accountable for those accidents. In the case of not putting any kind of legal entity around your business activities, if such a thing happens, you could be personally liable for what happens. So, say you're trying to build a startup, you're doing it all on your own, you're not paying attention to filing any works, you're writing software, and you land your first customer. And that customer is actually paying you money for a trial. And you have all these cool promises, and just stuff happens. It could be you can't meet their needs fast enough, or maybe you have a life event, which means you can't focus on it full time. Whatever happens, if they get upset and they sue, and there's no legal entity to sue, they effectively sue you because you didn't protect it. That's the liability that you don't want. The reason we have corporation structures like limited liability companies and C Corps, which we'll talk about, is so that people can put their vital energies towards the thing that they care about focus fully on the growth of that and the success of that without necessarily worrying about losing their house, losing their car, having, debts put upon their family. So the first biggest reason you probably want an entity is if you start getting other people involved in your startup activities, you'll want to be sure that you're protected from liability. The next step is you're going to create something valuable with your business activities, God willing, right? And in order to make something valuable, you want to pool those assets and that intellectual property into a business entity because at some point, maybe further, very far down the line, you might want to sell that entity or have that entity acquire other entities or merge into another entity or even, you know, the North Star of, high growth startups is to go public one day and literally sell that company to the public via stock. So if you're just running on your own, or even if you're small co-founders and it's unclear of like where the value is being created, you wrote software, somebody else designed a logo, somebody has a Rolodex full of sales, people that they can talk to. If that's not all coming into one central entity, the value isn't accreting into something, that would actually retain that value in totality. So you want a business entity separate from yourself or yourselves to put that value into. And lastly, as high growth startups or any business of almost any size that has more than two people, more than one person into it, things need to collaborate. People need to collaborate. The entity needs to collaborate across boundaries. It needs to enter contracts with other organizations. But especially in the early days, it's very important that the team itself has structures and mechanisms that allow it to collaborate and to share in the value creation in a fair way and in a clear way so that decisions don't get deadlocked so that when you're estimating opportunities or deals, you have clear sense of who benefits, how much, and who can make the call. Sorry, for some reason my next isn't working. All right, so that's why you want a legal entity. Now, obviously, like if you're off on a business detail, and we'll get into like really like when and the cost considering, it's a great idea to just have one, right? If you're semi-serious about what you're doing, why not set up a legal entity? But when is the actual tipping point? If you're just hacking away on a concept on your laptop and you're not even sure yet if there's something there, it's probably pretty safe that no one's going to come out of the woodwork and sue you, or that, there's anybody going to make a claim that they own all the code that you've wrote yourself. So you can probably continue on until you convince yourself you're going to go full time. But there's a couple inflection points where you'd really consider starting a legal entity. So we'll kind of bucket these with the categories beforehand. So what kind of things happen that would trigger you to want to protect your personal liability? Biggest ones is customers and contracts, external agreements with external parties where should something go wrong, they might have recourse to say, hey, I'm going to go sue that company, or I think they owe me damages or something like that. So this might happen in signing a contract. This might happen in setting up a Stripe account or trying to get an app in an app store. You'll find you'll hit some inflection points there where you're trying to get customers where they're going to want an entity anyway. The tipping point around assets and IP is pretty much bringing anybody other than yourself into it. Now, I think there's a case to be made that two people have worked together that are co-founding teams and they're together trying to prove the feasibility and convince themselves that there's something there can probably hack away a little bit, just early. But as soon as people start to regularly contribute to this, you're going to want an entity to clear up any of those conversations in the future and to protect, the idea, the people, people come and go for a lot of reasons. So as soon as you have external or as soon as you have contributors, teammates, and other people that are helping you, it's a good idea to get what they're doing into some entities because the last thing you want is 6 months later, the person that was hacking away on your prototype just disappears and you've got nothing to show for it. And kind of bleeding into collaboration, when you start getting other kinds of contributors, when you talk to advisors, especially if you're going to get investors, you're definitely going to want an entity. Entities like investors will force you to have an entity. Often it's a good idea to have an entity before even going out to investors so that there's no friction in the process if interest is established. But those are kind of the three tipping points of when you want to consider it. And so not everybody. It has a couple $100 to file a corporation and to do some of the things necessary. So how risk adverse you are is the other part of when. So like I said, you could have, your first customer could be your mother or, somebody that you know well, you're not afraid you're going to get sued for and you're still working on that. So the kind of three criteria is there's definitely going to be you have to forcing factors. Investors will force you certain kinds of customers, like if you're B2B, you're an enterprise solution, like nobody's going to sign a contract with an individual, if it has to go through sales or something like that. And then there's just some like filing things. Getting an app in an app store needs a DUNS number. A DUNS number needs a business entity underneath it, and things like that. Things that'll just force you into the entity or getting investment. The middle point of risk is when there is value at risk. If you've done something and you start to feel like we are creating something useful, we have customer lists, we have free users, we have software that we are proud of, we have IP that we think is good. As soon as you start to accumulate some of that, you're going to want to put that in an entity to have the conversations and remove the risk around disputing who owns what, and also to protect it. And then my favorite one, which is saying like if money isn't a super object, if you have a couple $100, maybe all in eight in the first year or so, do it if you can afford to. Like if you start working with one other person on a venture that you care about, and it's not too much to get yourself incorporated and get the whole company set up and get the IP in there, all you're doing is protecting things and making your path easier and making your ability to seize opportunities that much faster and clearing up, anything that could derail a success. All right, any comments on the when and why, Pete, you got? Or questions that I can help to?
No comments from me, but feel free, folks, to post comments in the chat and the Q&A.
All right, I'll have you get on that. So we'll throw this resource out and probably after the fact. We actually have a pretty handy flow chart we've had for years about how to pick the legal entity. So once we've established the decision tree of when I actually need one, what kind of legal entity do I get? And we're focusing this on US based startups. Most countries have a similar decision framework. They just have slightly different entity names underneath. So if you're staying in, a local country, this should be helpful, but make sure you check with the local entity types that you have. So this, I think I might actually have I can't switch to it, but this is big enough. But we have a nice little flow chart where you can see what I was talking about before is like if you're working roughly alone, there's sole proprietorships, there's partnerships. Once you get into some more details, like are you seeking professional investment? Do you intend to hire people? Do you expect to be profitable quickly, or are you going to reinvest any kind of revenue into the growing company? You'll start to see the entity types push more and more towards the thing all the way on the right, which is a C corporation, which we're going to talk a lot about through the rest of this presentation. But the two most popular entities you'll see on this chart are LLCs and C Corps, and we're going to jump into those because those are some of the most common entity types we see startups sometimes erroneously incorporating. So an LLC literally stands for limited liability company corporation. You will often see it, for people who go into a trade, they might have a handful of employees, they wrap the trade around an LLC. A C Corp is a C corporation. C is just the tax code underneath it. It's not a fun stumbling, but they have similar protections and then very different structures. And we're going to dig into which ones are appropriate for what business. So both, as you can see here, both limit liability. Set up either one of these entities and you will be protected in your liability. Caveat C Corp has some post-formation stuff we'll talk about. Well, LLCs are pretty simple. They both allow you to pool assets and IP. You can assign intellectual property from individuals or contractors or anything like that into the business entity. They both enable collaboration. The LLC's collaboration can be very custom. Sometimes people just get an LLC that's a member-owned LLC. It's two people. They both can make decisions based on the business and they go about their business. Others adopt something called an operating agreement, and an operating agreement can be very custom. It could determine, some person has an outside say in things, or all the votes on making decision, or gets an outside portion of the earnings of the company, because LLCs are what they call pass-through entities. So if there's a profit at the end of the year, that distributes into the owners of the LLC. C corps also have collaboration structures, but they're very structured. So they have to obey Delaware corporate law. And what you'll find often is a C corp adopts bylaws, which clearly spell out how decision making is handled at the corporate level. There's three corporate bodies, which we'll get into in a second, that have kind of a healthy relationship between them and how they influence the decision making of the company, as well as how the profits are shared in the event of a sale, profitability, dividends, etc. From an income tax standpoint, briefly mentioned this, LLCs are what they call pass-through taxation. So as you're doing business with an LLC, you will just file the business activities and the income on your personal income taxes. It increases the complexity of your personal income tax, but it will flow into whatever other kinds of incomes you have. And this is for all members in the LLC. Corporations are taxed on their own, like they're a separate entity than the people that work for them. So if you draw the salary from a corporation, you'll pay income tax on the salary and whatever other taxes are associated with that. And if the corporation itself has profits at the end of the year, they will pay tax on those profits or that income. Now, this is part of what you'll hear often called is the double taxation myth in C Corps, and why a lot of founders early days targeting high growth companies run away from C Corps and end up incorporating as LLCs because they hear the things like, I don't want to be double taxed. That's a dangerous thing. In reality, it doesn't really matter. When a corporation gets so big and its revenues are so big that it offsets its expenses and it's paying dividends like IBM, yes, corporate tax does apply. However, for startups, they're reinvesting every single penny of their revenue into growth and product development, as well as raising funds from investors, meaning that they are fundamentally in the red for years and years and years. So they never experience like debilitating double taxation in the early days, early years, some of these private companies, the early decades. So if you get spooked about that, I wouldn't worry about it. Even large, massive private companies and even some public companies still put the vast majority of their revenues back into the growth of the business. So this double taxation isn't a massive anchor around your neck, especially in the early days. That said, you do have to file taxes for a corporate entity on top of the individual taxes. So there's a little bit of complexity in your business life for running one. We help get rid of a lot of that. So stick with us. And then there's another consideration of the tax. If you follow from what we just talked about, if your taxes pass through to you every year on an individual basis with an LLC, you're going to pay short-term income tax on whatever that company earns. So it contributes to your income for each year. So you're going to pay short-term income tax. You might take a loss. A lot of people, the first couple of years take a little bit of a loss with their LLC, and that, benefits their income tax for the year. But again, it's a short-term income tax. For a C corporation, it's very, very different. Um, by owning shares in a C corporation, and we'll also get into the details of this, you have the opportunity for very, very long-term and tax-adjusted capital gains. So by owning shares of a C corporation for a sufficiently long period of time, in the event of a sale in the future, it's after 5 years or so, individuals can have a capital gains tax-free gain of up to $10 million per share. And we'll get into some details about how to maintain that. But the idea for a C Corp and the idea for a startup is you're looking for the long term. You and a group of founders know that this is going to be a 7 to 10 to longer year battle, but you are building for the future and you are deferring, any losses or small gains in incomes for those kind of big exit events, which we'll also hear an exit event is an acquisition or an IPO. All right, you've heard me mention this a little bit. I'll pause real quick. Any questions we got, or are you just sniping them in the chat? Good. So I mentioned Delaware a couple times. Delaware is still the gold standard in C corporations. So every state in the union has some version of a C corporation and LLC. I think they're pretty much all called the same in the United States. And what they refer to is a similar structured way of running a company with a bit more governance structures than a kind of as you will LLC. But overwhelmingly, you will hear DEC Corp or Delaware C Corporation in the world of startup and professional investors, angels, venture capitalists, things like that. Why Delaware? Well, Delaware has made it its business to basically run the vast majority of the corporations in the United States. The majority of public corporations are Delaware C Corps. The majority of IPOs are from Delaware C Corps. And that is because a significant portion of their work has been into corporate-friendly courts, a very well-precedented body of case law that gives investors confidence in how the law is going to be applied. So they're not going to have to resort to litigation if things go really, really well with your company because you had some non-standard operating agreement or you're incorporated in a state in which 100 companies over all of time ever even had an M&A or an IPO or something like that, and where it would go to a lot of different courts. So Delaware is really just overwhelmingly preferred. You will probably hear a lot of news articles about Delaware getting under fire in the last year or so by a particular billionaire. That has not to do with the early formation or the flexibility, the investor friendliness about Delaware C corporations. When you are the richest person in the world and you don't like how a court chooses to rule on your compensation package, you might make a stink about it and try to, move to other areas. But we still see Delaware as the overwhelming choice, and has been for quite a while. And it gives investors a lot of comfort. They're used to writing these things. They're used to the standard documents. They don't have to have their lawyer read over every single thing if it all looks the same. And often you'll find complex operating agreements, Byzantine corporate structures, constellations of units of entities across multiple states or even the same state is enough for a tacitly interested investor to just say, no, thanks. All right, so this Assuming you would choose a Delaware C corp, but this should apply for most C corps. And I think I implicitly made the case is now we're focused on the Delaware C corp path. This is you've made the choice. You're not a limited liability company. You are going after whether it's professional fundraising from angel investors or venture capitalists. You want to grow a big company, so you know you're going to have to incentivize employees with things like stock options in the future, upside in your company with tax advantages to it. And someday there is an exit event in your sights. You know, it could be far, far away, but that could be an acquisition by a larger firm or actually going all the way to going public. Pretty much saying yes to any of those puts you in the Delaware C Corp territory if you're trying to make a US startup and going after the US markets. So let's assume we're making a Delaware C Corp. What does that entail? Now, I'd say 10 years ago, I would probably give, knowing everything that I know, when a founder said, "Hey, I'm starting a thing and I think it could be big. I'm super excited about it, but I just don't know. This is my first time, but I'm going to go for it. I'm going to make this company. What should I do? What entity type should I set up?" 10 years ago, in order to get an LLC, you go to a clumsy State Department website, you click a bunch of boxes, you maybe pay 200 or 300 bucks, and you have yourself an LLC. Your liability is protected. Go about your business. See if it works. So I probably would have said that because the alternative to setting up a Delaware C Corp 10 years ago would be go to a lawyer, have a lot of conversations. They'll give you a leather binder. They'll charge you $3,000 to $5,000. They'll do the filings. They'll set up your board. They'll give you all the paperwork. They'll hand you bylaws that are like 30 pages big. You know, PDFs stack up, and you trust the lawyer that did everything right. And then you go about your business. But now you've paid 3 to 5 grand just to take a shot on a thing. Things have gotten much better in the last decade. Now you can get pretty much a Delaware C Corp and an LLC set up compliant and kind of mil spec standard for roughly the same amount of money, maybe a little, another hundred or so on the Delaware side. So I would say if some of these structures scare you, worry not. There's solutions out there. We have one that will really make this a lot easier. So what is actual formation? First, it's literally just filing something in the state of Delaware. It's an approved, ours is for Gus Launch. It's a single page, 10 article certificate of incorporation. And it says, I'm setting up a company. This is the person who's doing it. It's going to basically obey Delaware corporate law. It can have bylaws. It can do business. And the people who are starting it are protected from liability. That'll come back in 2 to 3 days from Delaware with a nice stamp on it. And at that point, you also say how many shares you have. We'll get into that in a bit. And now you have a nice new corporation on file. However, that is not enough to complete the formation. So best practice is you should adopt a bylaws shortly afterwards. Bylaws, like I said, are 30 to 40 pages that just say how the company is going to do business. They're pretty rote standard. They have to comply with Delaware general corporate law. But by adopting bylaws, you make some clarity around things like we can have board meetings without sitting in a room together. We can do them digitally, or we can just all sign a document, you know, in lieu of meeting that says we made a decision to really streamline how you can make decisions with the business and not have formal board meetings and take minutes and things like that. And there's a bunch of other things like your fiscal year and, you know, the powers of officers, powers of directors, which should mostly be standard. All right, so you got a filed Delaware corporation. It has bylaws which determine how it can make decisions. The next body is the board of directors. So you'll want at least one director. In the early days, it's if it's a solo founder, it's you. If it's two founders, it's fairly typical to maybe have both founders on the board. Depends on the relationship between them, which we'll get into in detail later on. The next is officers. All Delaware C Corps need at least a president. Often the president and CEO officer roles are merged, and a secretary. You can optionally have a treasurer. It's usually best practice as both. These are not officers like most people think of, like a CFO or a CTO. Those are for internal organization and decision making within a larger company. Delaware really just has three fiduciary responsibilities, and that's president, secretary, and treasurer. One person can be all three, and that's pretty common in the early days. And then the last thing, something we poke our founders at on launch a lot, they get everything set up and then they kind of tiptoe around the equity issuance. You want to be sure you issue shares to the founding team members, at least one founding team member. Because without all three of those bodies, those governing bodies, the board of directors, the officers, and the shareholders, which is somebody who holds equity, the corporation is not fully formed. What they call the corporate veil has not been established. So should you start doing business activities and then something bad happens, somebody sues, it could be found in court that what's called piercing the corporate veil, which is like, hey, this wasn't a corporation. This was just like two individuals like running a thing. So now you lose that liability protection. So you want to be sure you have those bodies set up. And it's not as difficult as it sounds at all, as we'll jump through. So once you get that all done, you have completed formation. Congratulations. You have a real business entity with real decision-making apparatuses and ownership so that should good things happen and as value increases, those people will be able to share in the value of that venture. Once you get that set up in a given calendar year, you're going to have to stay compliant as you do business. And most of this is just on an annual clock. So we've said Delaware a lot. Chances are not a lot of you are in Delaware. So you're going to be incorporating what's called a foreign corporation from the eyes of the state that you do live in and do business in. We recommend within the first couple months after you get your Delaware corporation back, file a what they call foreign qualification, or sometimes like the articles of authority or certificate to operate, or depends on the state. But it's just a foreign registration that says, "Hey, I have a Delaware corporation, but I'm doing business out of this state." In the beginning, it's usually just the founding teams. As you get bigger and you start doing business activities, you might need to foreign qualify in other states. Each state has slightly different criteria. It's not a ton to worry about until you really start doing meaningful business, but at least get one state done in the first year. You will owe annual franchise taxes in Delaware. We will send you letters with "Don't panic" written on the top in a bold font, being like, they're going to send you a total that's ridiculous. Don't worry. You're going to go to the minimum every year. It's $400 with a $50 filing fee. Until you literally have millions of dollars of assets in the company, it won't rise above that unless you do some really squirrely stuff, which we will help you not do. And then you'll have corporate taxes. Like I said before, the corporation is taxed as a separate entity. Each year you'll want to work with a tax attorney to do it. Again, it's not terrible. I think our tax partner is like $320 or $330 for annual taxes for a company with like less than 50K worth of revenue. And that only scales in the hundreds until you're like making serious money where it probably isn't too much of a concern. But it is worth using a tax attorney because it's more complicated than personal taxes for sure. All right. So that's get a fully formed company. I glossed over this idea of like, be sure you issue shares to your founding team. And how come companies, often kind of delay on that one? It's easy to point the board and put some officer hats on people, especially if it's just two or three people. Uh, when you form that corporation initially, you're going to authorize shares in the state of Delaware. And you'll see commonly Gus launch, all companies get authorized with 10 million authorized shares. Why 10 million? Seems like a really big number. Well, as we'll get into some details, you want enough shares to incentivize everybody who's going to join the organization over the next couple years. And 10 million is just a decent high watermark. We've got 10 fingers. It's just enough so that we have enough to make all these team members give them the right amount of ownership, because you're going to be granting very small amounts of ownership to some people. And in the early days, that's all done through common stock. So when you put that 10 million down in Delaware, that's basically saying I can't issue more than this. But ownership is only ever based on how much is outstanding at the given moment. So it's not like my denominator is 1/10. If I issue myself one share, I own 1/10 millionth of the company. No, if I issue myself one share, I own 100% of the company. However, if somebody else comes along and I issue them a share, now we both own 50% of the company. So as you can see, having a lot of shares allows you to reflect ownership levels of some complexity as the company grows. So common stock, predominantly for founders and early team members. It is not the stock that you sell to your equity investors. So you don't have to worry when you start your company about how much to reserve for those wonderful investors that are going to come in 6 to 18 months or something like that. You're not going to be running your own private stock exchange, like marking up your own common and selling it, something. You don't have to worry about that. Common stock is generally what I call like the indelible stock for the most part. It's where we started out, who owns what, and let's get off to the races. And when we have success and when we need to raise more money, we will figure out what makes sense in the future, and we'll get into some detail about that. So, as before, talking about collaboration and aligning roles and responsibilities, the common stock distribution point is a really great opportunity to make sure everybody's on the same page. So putting that line in the sand that's saying, "Hey, this is actually kind of elegant for Delaware." When you're talking about building a big company, you don't just file a piece of paper that says, "Hey, let's do business," and nobody's liable if we screw up. You file a couple of papers, you set up some decision making, maybe one founder's on the board or two out of three, but then you get into, okay, who gets what share of stock? And that is an important conversation to have in the early days because it really sets clarity around who is contributing what to the business and what share of the spoils, should we be successful, will they have. And getting into those roles and responsibilities is actually really important. There's some online wisdom out there that says, just split it 50-50 or 33-33-33 and get off to the races. We advise against that because we have seen time and time again that co-founder infighting and disagreements, or when things happen well and everybody was on slightly different pages, they can tear apart a company a lot faster than running out of capital, especially if they haven't had any capital yet. So having that conversation, we'll get into some details of what goes into that in a little bit, is very important. So 50-50 splits are kind of rare. Often you see maybe 70-30 with two co-founders, depending on who's bringing what to the table. With, three or four co-founders, it's not uncommon for two to be kind of the heart and the hacker hustler, and then two others to just be like really top-notch contributors, but maybe they're taking a little salary in the beginning or only working part-time. That conversation, there's a lot of nuance to that. And we have a tool for that, which Pete will probably throw in the chat, but I think I actually walked through parts of it in a little bit, so you get a sneak peek. Don't throw the link in yet. All right, so you've decided how much to give each person based on what they're going to bring to the company. Um, the one thing to protect the company is what you don't want to happen is you have that hard conversation. Let's say you're a team of three, one's getting 60, one's getting 30, one's getting 10. And 2 months later, the person that got 10 is like, oh, wow, this is a lot harder than I thought. Going without pay sucks. I'm going to go get a job. They walk away from your company and they have 10% of it. And they've only been with you for 2 months. That is one of the worst case scenarios in the early days. You don't want what's called dead equity on your cap table. You don't want a significant shareholder who is no longer contributing to your company. Everybody who's in day one, they should have a minimum expectation that they're going to be here for 4 years if things go well. It's possible things won't go well, and 18 months later, there's no company to work for. But startups are a ton of work. Jobs are a ton of work, right? You go and work in a new corporation, it takes you a year to figure out what your job really is. And if you really want to make meaningful dents in the organization, 3 to 4 to 5 to 6 is actually not uncommon. When you're talking ground up, 4 years is pretty much the minimum. So how do you protect that arrangement is what's called vesting schedules. So when you grant common stock to co-founders, they get the immediate ownership that is, promised. So using my example, say that 10% owner, they have 10% voting rights. Should there be shareholder votes, their votes count for 10%. That's real ownership. However, that stock grant will have what's called vesting on it, which is technically reverse vesting. So it's not their right to earn the ownership. They get it all day one, but it is the right for the company to repurchase that ownership at the same price should they leave during that vesting schedule. And the amount the company gets to repurchase is whatever is still unvested at the date of departure or termination. This is the number one best tax incentive, easiest way to get equity back into your company when bad things happen. People leave for all sorts of reasons. Some people start a company all by themselves and they're looking for a co-founder and they think, I don't need vesting. The company's nothing without me. People are going to make you put it on anyway. It shows commitment to the business. It's easier to do up front than it is to amend because you usually have to pay lawyers and you have to do some tricks and sometimes you have to wait. But all common stock grants should have vesting for any kind of contributor relationship. There are some cases where you might do a grant to establish ownership or other things like that. But when we're thinking about people joining the company to push it forward, all should have a vesting schedule. Most common vesting schedules are 4 years for founders with a 12-month cliff, which means that not even until 12 months of time pass do they get any of the repurchase. Does the founder secure a quarter of their grant? So it takes them a year, like I kind of said, it takes a year to figure out if your job's really real, for them to lock that cliff in, and then it's usually month after month after that. So the idea is if somebody leaves in 18 months, chances are they contributed a lot if they kept with the company for 18 months. But any people can leave for any reason, right? A life event happens and somebody says, I just can't put my full effort at this anymore. I'm going to move to an advisor position. It's like, great. We love the contributions you gave us for the last 18 months. Here's 18 months worth of your equity fully vested. You own that, but we're going to terminate you as a co-founder, maybe bring you back later as an advisor for a much smaller equity share because you're not giving it your all. And then I talk about all these promises, not good enough to do in handshakes and emails or meetings at a bar. You want this stuff documented. And anytime you discuss equity, like you're going to have to negotiate and discuss around it. Do not make it clear that nothing is formal until the docs are signed. You don't want just dangling promises. You don't want to say, hey, we're 60-40, then start working. And then 3 months later, when you land the grant or you have a serious investor and they ask to see the grant documents, all of a sudden there's a fight about how much work you did, how much work I did, et cetera. Even if roles change in the future, having the grants gives you the bedrock to make the right kind of conversations to adjust things when arguing over mixed understandings can basically just spin you in circles. And after all that, file an 83B election for your common stock. What an 83B election is because you're getting stock, which will increase in value over time, hopefully. uh, by default, the IRS will recognize the income for that stock each time it vests, because to the IRS, that is the irrevocable point where you own it until you sell it. Nothing can take it back from you. Um, if you're building a company that's growing, that stock that you bought day zero, which I haven't mentioned this, but usually when you incorporate in Delaware, not only should you incorporate with 10 million shares, but you put a really, really low value on those shares. With Gust Launch, our default is four zeros and a one after the period. So that's like 1/10 millionth of a dollar. You want it that cheap because in day zero, your company is basically worthless and it's super cheap to buy your equity. Literally 5 million shares in a company like that costs $50. And you keep that transaction clean and you own that. By filing an 83B election, you also say to the IRS, I'm going to pay the income tax on all this shares up front. And because they cost the same as I paid for them all in the same calendar year, that is zero. Done. Never talk to me about income tax on these shares again. The only time I will recognize tax on these shares is if I sell them later at a massive gain. Um, in almost all startup cases, you want to file an 83B. Why wouldn't the IRS think about that as default? Well, they're flexible for a lot of different situations. There's a lot of C Corps that aren't startups. You know, they don't start from really, really low value and try to grow really big. They might move substantial assets. They might have losses one year, gains other years, things like that. So by filing the 83B, you're basically giving up your ability to take losses on the value of those shares dropping, but you literally bought that at 1/10 millionth of a dollar, so they can't drop much further than that. So for almost all startup founders, filing your 83B for your common stock is a no-brainer. And it has a 30-day window. So be sure it's 30 days from the date of the grant. Most grant dates are when the counterparty signs them. So usually the CEO will send you over the grant, and then when you co-sign it, it's on that date. Sometimes you can push them into the future, but be sure you file that 83B from 30 days from when the grant was complete, because the IRS is very finicky about that. All right. Any questions you want to float up for chatter times, Pete? Cool. I see the chat going, so awesome. Thank you very much. All right, so I talked about common stock. Um, it goes to the early founding team members, sometimes advisors, sometimes contractors. Um, but how on earth do investors buy stock? And so you can see here, we kind of have a rough bucketing of the kinds of rounds people talk about and the kinds of traction a company has. And you can think of this as like the stages a company goes through, assuming it's growing. In these first three rounds, the majority of people who invest in companies do not buy stock directly in the company. So you can see this is all the way up to even maybe a $2 to $5 million round. That's a $5 million round is a round right around the tipping point where you might consider actually selling stock. But anything before that is usually just earlier. You're so early in this stage of the company that talking about how to purchase stock in the company for a value bigger than what it was incorporated with is almost fruitless, because everything is so early. The traction is so minimal. The product's still being worked on. In the case of, a hustle round, you might just be pulling in money before you've even monetized the thing by people in your personal network that already believe in you. They're not investing based on the economic upside. They want an economic upside, but they're not looking at your traction so far and thinking how big you can scale it. They're betting on you figuring out a problem, figuring out a market. So if they're not buying stock, you probably hear about this all the time. Companies raise money. They raise millions of dollars, during these periods of time, from hustle to pre-seed to seed. So what exactly are they raising that money through? And what they do is they raise that money often through what's called convertible instruments. The two most common are convertible notes and SAFEs, simple agreement for future equity. There's another one that's dropping in popularity called the KISS. Very similar to the SAFE, just came from like a slightly different, I think it also came from the 500 Startups Accelerator. But what these agreements are is SAFE spells it out. It's a simple agreement for future equity. It's an investor taking a bet on a founder, on a business, on a market, but recognizing that on both sides of the table, negotiating around how much value the company has built so far, what its valuation is really, really hazy, and it's not worth spending a ton of time on. That would actually need you to pinpoint the valuation. So what I mean by pinpoint the valuation is when you do sell stock to investors, you negotiate how much the company is worth before their money comes in, and you use that to determine how to create new stock, how much to price it at, and to sell it to them. So I said before, investors don't get common. So what do they get? They get often what's called series preferred convertible stock. And that is a new class of stock. So you go back to Delaware. You say, yeah, Delaware, we have 10 million authorized shares of common, but now we're amending our charter and we're authorizing a new share of stock, and we're going to call that Series Seed Preferred. And Series Seed Preferred stock comes with a ton of other documents. It's not just one page at Delaware anymore. Those those new classes of stock come with a bunch of rights and obligations that are often better than the common stock. It gives investors often, last in, first out. So if the company does sell, the investors are paid off before the common stock shareholders are paid off. It comes with rights to negotiate their place because now they're shareholders of the company. Each time a founder raises funds, they often sell between 10 and 20% of their business in rounds, kind of seed and beyond. And that means as they grow, more and more of their company is going to be owned by investors, not just by founders. So those investors are going to want some representations. They're going to want some protection as a shareholder of a particular share class. So in order to create that preferred stock, you have to agree, all right, how much is this company worth? Using the trivial example of if the founding team and the investors agree that the company is worth $8 million and the investors want to buy 20% of it, and they give $2 million as part of a seed round, at the end of the transaction, it's a $10 million company because they both agreed it was worth $8 million. $2 million went into it. 8 plus 2 is 10. So now it's a $10 million company. The investors own the equivalent of $2 million at that very point in time, so 20% of the company. And then you would use that math to figure out what to price those new preferred shares at and actually sell them to investors with the corresponding documentation that you would adopt during that. We don't want to do all that when we're raising small amounts of money. If you're raising $250,000, $500,000, things are super early. To get a proper series preferred stock done, it's going to cost you probably tens of thousands of dollars. There's going to be lawyers on both sides. They're going to have to comb through the documentation and the rights, and there's going to be negotiations. And when you're raising $300,000, $400,000, it does not make sense to spend 10 to 20% of that on legal fees when everything could go poof within a week or not a week or two, within a couple months, right? You could run out of money, the experiment couldn't work, the market could shift, who knows? And why do we spend all that money? That would have bought us 4 or 5, 6 months worth of runway. So that's why these convertible instruments come in. They allow, I should switch to this side. These are the people who are purchasing stock. Look at this, I'm getting ahead of myself. This highlights most of what we're talking about. Some of the provisions like board seats, additional rights, liquidation preference, anti-dilution clauses, all the things that go into preferred. I guess we don't really get into safes and convertible notes in this thing because we're more talking about formation. So I'm going to wrap up this safe and convertible note stuff by saying this is grounding you why founders get common stock and why you don't have to worry about all the investor purchasing stock or the investor stock layover or making room for them when you initially form your company. You can defer that to the preferred stock round. And there are fundraising instruments like safes and convertible notes that will allow you to take money in early and defer the actual specifics of that conversation. It is worth knowing that you're still going to negotiate things around valuation with investors on those instruments. There's just less to negotiate and it's less expensive from a legal standpoint. All right. So common stock. I talked before about a co-founder equity split and actually putting a lot of rigor into that conversation. We have a tool for this. Pete can throw in the chat. It's a free digital tool that will walk you and your co-founders through an interactive survey, weighting the contributions across relative to each other. And you can see some of the questions in here. There's probably like 60 or 70, but there's a couple ideas like who's actually participating, in the fundraising, who's actually building the product, who's putting their own money into the business in the early days, who actually does the pitches. And as you go through these questions, you'll start to realize like, oh, there's a lot more to this for most people's roles. And you'll get a nice equity split that pops out the other day. Even single digits are meaningful when it comes to governance and decisions, and there will be some backup in this tool. So it's a big help in those early days, and it will also help open people's eyes to what actual contributions are expected from co-founders. We talked about vesting before, but this is a good way of visualizing the kind of cliffs. So a stock grant of some amount each month after a certain cliff, they vest more and more until they're 100% vested. And then a lovely visualization of 83B. Sorry, I got a little ahead of myself talking about the details of this, not realizing I had slides to support it. But this is another visualization of as your company grows in value, why you want to file that 83B election. Because the income tax, you just pay it once and it's zero, while as the company's increasing in value, you don't want to be paying it over time. You want to defer that to capital gains. As I said, I mentioned it multiple times in this presentation. We have a really cool product that does a ton of this. If some of this is like kind of scary, there's a lot of there's a lot of reused words that mean different things in different contexts. Gust Launch is kind of guardrails on corporate governance. We put all the smart defaults in place for you. We basically set it up for all the standards, and anytime you need to you're trying to go outside of those standards, we bump you a little bit. We don't say it's impossible, but we really set the context and the education, kind of like we're doing here, to say, hey, you can make, this is why startups do it this way while other businesses do it this way. This is why investors look for this. And it's a really big help to make it so that you can mostly focus on what you should be doing is building a growing company, making revenues, finding partnerships, raising funds, not dealing with bespoke corporate back office tasks like, oh, should I file an 83B election, or, do I sell my common shares to investors? So launch is great. It starts at incorporation, but welcome to 2025. We're able to help people who've already incorporated. So oftentimes you will find it difficult to put your already existing company kind of DIY into a structure like Launch. Launch saves a ton of money because it is so standardized, but we're starting to be able to kind of coalesce those standards around existing entities. So reach out to us. There's a link to Launch. There's support chat, or even just to email support, and we can see if you're a candidate for that. If you're not sure yet, if all this stuff is like, oh man, I think I'm building a high growth company, but like I didn't think that I was going to go to Delaware, or I was going to have all these like layers of governance. We have something to help before all that, during all that, and then once you even make that choice. We call it Mission Control. It's like a startup accelerator, but it doesn't take any equity. It's not cohort based. You don't have to graduate from it. It's kind of go at your own pace. Sometimes, if your pace is really fast, you'll be increasing Pete and I's pace. Sometimes, if you really need to just get your head around all these concepts, you can take it, as it comes. We do a ton of programming in it. We do custom workshops for Mission Control members. They're basically like our higher touch founder support community. We do office hours every week. We do pitch practices where you give you real feedback from real investors, not just asking you investory questions, but actually telling you what we're thinking and why we're, full of disbelief based on your claims. And then we do focus stuff on founders. We help founders get unblocked and use it as a demonstration for other founders who might not realize they have similar problems. But it's super participatory, learn by doing, full of great people. We have an awesome network of experts that are helping founders out. And we design these things to be super complementary. If you're in mission control, you use it for a month or two to figure out, I do want a Delaware C Corp. I am building a high growth company. This is awesome. And now I know my capital path and I know what I need to do next. And you're ready to jump into it, you get 40% off all the other stuff that we offer. So you can incorporate for cheap, kind of basically, you've basically bought yourself the de-risking and then the new corporate streamline entity to go forward. So check out our stuff. It's super fun. We're having an amazing time running the Mission Control program, and it's just helping make more launch founders and more founders successful, hopefully. All right. Sorry, I ran 4 over. Thank you, Pete, for
No,
the
you're
warning
good.
through however many channels you send it.
You got it. That's my job. All right. So we do have some good questions in Q&A. I will give you 1 second to take a deep breath, and then we'll get started.
I thought I tried to speak slow, but I didn't. I'm good.
Okay. So first up, Fernando asks, if they want to build a broad-based company, what's the best way to think about the legal entity and the IP protection?
Ooh, a broad-based company. If you want to add a little context to that, Fernando, but I think I know what you mean. A lot of times founders in the beginning, they have very big visions and they start to imagine like a constellation of entities where it's like, oh, I'm going to have, an advertising agency, but that works for my product-based startup. And then they're also going to work for my, services arm that's going to like start to use the technology that my product-based startup is building, but, charge for consulting for it. So should I bill it through here and this and that? There's some fun gymnastics you can do there with both taxes and decisions and things like that. What brand owns what IP? But I would advise most people, it's so hard to take one entity from 0 to 1 that it's often best to defer the decisions like that until something is actually working. Decide upon what the first success criteria is going to be and what entity type meets it in and of itself then build that and start to make momentum with that and then make the choice if you're going to augment that with something. If you try to start 3 to 4 different companies at the same time and establish, complex relationships between them, you're going to scare investors off real quick because they're not going to have a lot of confidence that the value is going to accrete in one of those entities that they own something in. Sometimes you do holding companies later, but that's usually when you have something to hold. You don't want to design a holding company that holds uh, 11 other empty companies and nobody's clear as to what's creating the value. Excuse me. So that's usually the best advice in the early days. But once you get to that level, like you should be working with accountants and corporate lawyers that can help you make those best decisions. I think you'll see there are certain classes of startups that do have to have splintered entity types just to play in the domains that they're playing in. The most common is financial services. Our banking partner Brex actually has like three or four different, they have a C corp that runs the software company that is Brex, that builds products that, people sign up at Brex.com for, but they have a treasury LLC that handles the relationships with their partner banks and like some financial transactions that they have to do. But I guarantee they set that up with the very heavy-handed guidance of lawyers and law firms because they have to, because they work in a regulated space.
Cool. And I think that overlaps with a few questions that we have around foreigners starting US-based companies and companies that work outside the US. I can start with a couple of these and have you chime in, Nash. But if a company is working outside the US, typically the benefit of incorporating in Delaware would be if you are going to go to market in the United States or if you are going to seek capital in the United States. And often those things are pretty heavily intertwined. So you won't see too many investors investing into US-based companies that largely are going to market in another country. So if you do plan to go to market or you do believe that you will be able to credibly seek US-based capital, then a Delaware C Corp is often a good choice. But if you are fully operating and going to market outside the US, you can carefully consider that. In terms of limits to foreigners starting companies, you can absolutely start a Delaware corporation without being a US citizen or even without residing in the US. You may need a physical address in the United States to work through and get a corporate bank account, but even that requirement is being relaxed through different providers. One thing to note, though, is if your company is primarily held by a non-US citizen, or a non-US citizen exerts control over the company in some capacity, you will have additional filing requirements um, that you'll have to do for the company for anti-money laundering and things like that. So keep those in mind, and there will be additional tax forms that you will have to file for a company that is primarily held by foreign owners. You may also have some local regulations and tax stuff that will impact you. So understand that as well. Anything else to add on those, Nash?
Only that I think Pete rightly said is like significant influence. Don't try to hide things basically with your corporate thing. Don't try to be cute. Like, oh, what's the absolute minimum disclosure for like my foreign beneficial owner if I keep them under 20%, but they're also on the board and they're officers. Like, can I get by these things? The way the law is rolling out is like they're going to constantly make it more so that, like if somebody is significantly influencing the organization, they're going to want to know about it. So it's not worth trying to sidestep it on technicalities.
Cool. And Manish, asking about a Toronto-based company that wants to set up in Delaware and raise US capital. Generally, if you do that, the standard way to do it is called the Delaware flip, where you incorporate in Delaware and the foreign entities become wholly owned subsidiaries of the Delaware corporation because of the amount of available capital in the US. That is not the only way to do it, but that historically has been the way to do it. Okay, next up, we have Bill Davis with How About a Benefit Corporation?
Ah, wonderful. Can I go backwards? Yeah. So you can basically take this whole presentation and pretty much replay it for a benefit corporation. So a benefit corporation underneath acts just like a C corporation. Same bylaws, same Delaware corporate law. Well, not same bylaws, but almost all the provisions and things like that are the same. The one difference for a benefit corporation is on their COI, they have a social benefit that is there to say that it is you traditionally the decisions for the board is to be on the behalf of the shareholders. Whatever is best for the shareholders is what is best for the company. A benefit corporation has a social benefit that they can also use in that decision-making calculation. Now, I will say in the early days, the differences between governance are almost non-existent. A benefit corporation still is largely meant to be, not meant to be, but is most useful in a marketing capacity, being that your social mission is literally on your COI And there's some programs out there like B Corp certified, what actually says like, hey, you're achieving your social mission and your social benefit. A lot of startups do use that, to signal, the kinds of culture and the kinds of decisions they're going to make. You can use that in both investor meetings and partner meetings and customer conversations. But at the end of the day, it's not going to change much of your corporate machinations.
Cool.
And
All right.
oh, last thing, if you are interested in starting one and you want to go with launch, just reach out to us. Um, we often advise for ease of use and because our software isn't there yet, that if you just get a C Corp up and running and start doing it, you can amend it and make it a benefit corporation later and get certified when it makes sense. But if you want to do something from the early days, I think we can handle it. You'll just have to work with us before filing it.
Cool. All right. Next question. Does it make sense to start as an LLC for short-term benefits and then convert to a C Corp as you grow and start looking for outside investment?
Oh, this is a fun one. Um, it'll be interesting to get Pete and I's like differing perspective on this. I'm going to say it can make sense, depending on your situation. So if the idea is you are trying to min max um, certain gains and savings, it's usually just not worth the hassle. If your goal is growth, if what you're saying is like, I want to build a big company, I want to either sell this company or IPO it, I want to hire people, I want to make something big, and all I'm thinking of is, min-maxing my tax situation on the way to that, I would say don't bother because the min-maxing you're going to do is a couple grand and you're going to add a ton of hassle and you're not going to start the clock on one of the most important tax incentives, which is QSBS for founders, which starts at the 5-year holding period I mentioned on this slide. So if that is your goal, high growth company or bust, usually like taking a couple losses on your personal income taxes for your startup expenses doesn't really net out for not starting the clock, for not having everything streamlined and up, in front and, frictionless fundraising and all that kind of stuff. However, if you're kind of going at like, I'm going to go do business and I think it could be something big, but I also know I have an off ramp if I create like a really compelling services, business or a producty business that has a big service arm and I want to entertain those options, then you're in kind of you know, a gray area of the kind of decision you want to make. Do you want to start doing business and make money instantly by doing like consulting and use that consulting to build into a product that maybe the LLC owns that you'll spin out later, but you still might run that consulting business? It might be worth doing an LLC because that LLC is doing consulting. So that's legitimate. We have a number of founders who literally do that and they say, hey, we had a thing and we're just going to put that into a Delaware C corporation and the LLC keeps running. And then the new Delaware C corporation gets a bit of an asset transfer and goes off. You give yourself some flexibility there.
Yeah,
Any
and I agree with that wholeheartedly. I think it can be a good idea in some situations, especially if it's just you kind of kicking tires on an idea. And then once something has legs, you immediately transfer all the IP into a corporation to try to make it big. That makes total sense. Just keep in mind, the more people involved in the LLC, contracts, employees, investors, members, the more likely you're going to have difficulty or additional costs making that transition. So you kind of have to weigh that. And also beware of the S Corp election. If you take the S Corp election on an LLC and then try to convert that LLC into a corporation, you have probably blown the QSBS qualification that gives you the big eventual capital gains tax advantage. Okay, next up. If you're a Delaware LLC, but your business is 100% online, do you still need to do a foreign registration in each state? And lightning round-ish, we're at time.
Cool. Not in every state that you do business in. Generally get set up in the state that you are in. As you grow, you might achieve economic nexus in these states, and you'll have to start doing sales tax and things like that. But by then, you should be working with a tax attorney to help you make those decisions year over year. So just because you might have a customer or even a remote team member, don't get too spooked. You can make these decisions over time, and it's usually once meaningful business is being done that you want to consider foreign qualifying in more states.
And follow on question there. Generally, if you do have an office in the state or you do have a W-2 employee in the state, that is a pretty clear establishing of physical nexus, which will trigger foreign qualification. If you're an online business that is selling a bunch into a state, that may trigger economic nexus, which also then triggers essentially physical nexus. So once you're doing a lot of business in a state or you have employees in a state, generally those are the times where there's no question that you should foreign qualify. Okay. Should co-founders have vesting too, along with employees?
Yes, all founding team members, and this will actually get anonymous in the Q&A too about a solo founder having vesting. So the reality of this is, like I said, is you own your stock immediately upon the grant, even if it has vesting on it. So there's really no risk to you as a solo founder or even two co-founders who absolutely adore each other and say they're never going to break up and they're always going to do 100%. It's like, all right, if you're always going to do 100% and that's true, the vesting will be done and you'll be full owner after a couple years anyway. If you're a solo founder and you have vesting and you're on the board of directors and every other position in the company, who's going to terminate you? There's nobody that can. So vesting does not hurt you at all. All it does is say that you are being long-term oriented, you understand investor expectations, and you are putting the corporation above any particular member because you know that life can happen. And if good value is happening in the corporation, we want to save it for whatever keeps moving it forward.
And this goes into the next question. Must founders revest if investors ask for it? Um, Generally, if you were talking about the typical equity investor and your shares aren't vested and they were relying on you being at the company for a period of time to put their money to use, they will very often ask you to revest your shares so that the vesting schedule aligns with the time that they expect you'll have to spend in the company to make it a success. Now, you can always say no, but they then may also say, no, we don't want to give you our money. So even back to the previous question, if you're a solo founder, you don't necessarily have to have vesting, but once you start bringing somebody else on, or once you start asking equity investors, you're asking for somebody to come in and collaborate with you on a long-term venture. And if your equity holdings don't indicate that you are incentivized over the long term, that's going to be a point of contention with that person, whether they're a co-founder, early team member, or investor.
And I'll just add one thing to that is good investors, professional investors who do that often want founders to have a significant piece of skin in the game, just like themselves. So don't approach the kind of vesting and the ownership conversations as if it is a, they're sharks, I'm minnows. It's like most investors want founders to have a meaningful ownership percentage and a commitment to the success of the industry. And startups often come in chapters, right? You might be fully vested by the time your Series B conversation is, but part of that conversation could be like, hey, we're actually going to give you more equity on new vesting schedules because we want one you to have more ownership of this great thing that you built, but be committed to it for another 4 years because that's the next chapter of the company. Don't get too worried about that. Enter these conversations with kind of clear eyes that both sides are looking for the shared success. And if you
Yep.
get the
And I mean,
feeling like they're not, that's an
yeah,
investor to avoid.
right. And that is why it's a good idea to have a passing understanding of all of this stuff, is so that you're not entering a conversation where the other person has vastly more information than you. You want to enter it understanding roughly how these things work so you can tell a good investor from a bad one. Okay, what happens if you want to close a C Corp if everything goes wrong?
If you want to close a C Corp if everything goes wrong,
Yep.
well, if you're on Gus Launch, we cover what's called short form dissolution. We literally have a plucky workflow while you're canceling your account that asks you like, are you canceling because like you're going in a different direction, or are you canceling because you're dissolving? If you go down the dissolution path, we'll hook you up with the filing providers, pay for the dissolution fee, which isn't too much. You'll pay your last round of franchise taxes, and the corporation will cease to exist. That is if the bank account's at zero, there's nothing left to salvage, etc. If you got to some level of success, but like either you're bailing, you want to shut it down because you want to like pay out what's left in the bank account to investors to like make good on your professional reputations. It's not working out the way you wanted it to, but like you could limp along for 10 more years, but you don't want to do that. Then you'll have some more difficult decisions to make in how you actually wind down the company. But the factual filings and stuff like that don't get too much more complicated than that. I believe there is a long form dissolution that might handle if the company has sufficient assets left, it needs to distribute them in various ways. But
Yep. And realistically, this is very similar if you have an LLC,
yeah,
except if it's just you, then you are the person to whom everything flows, remaining assets, et cetera. But you are liquidating assets, you are following up with creditors and investors, typically in that order. You are filing a form with the state that says this thing is going away. and you are filing a final tax return, either a personal or business, that basically puts a pin in the entity and the business operations from an IRS standpoint. Quick clarification on tax lawyer versus CPA versus accountant. Are these all the same thing or are they different?
Uh, they often sit in the same building sometimes. So mo I believe most tax accountants need to be CPAs, or I always forget. What's the other one? CFP? No, CPAs. It
Yeah.
doesn't matter. You want a tax accountant to handle your corporate taxes. There's somebody who's familiar with corporate tax law, etc. Um, you can have a personal accountant. Often, once you start running a company, the person who handles your corporate taxes will also handle your personal taxes to make that easier. They are meaningfully different from a bookkeeper. A bookkeeper is somebody who actually keeps the corporate books and keeps track of revenue and expenses and puts it in the appropriate boxes. CPAs, in terms of advisors, usually not necessary in the early days for startups. You want somebody to do your taxes, you want somebody to keep your books. But when it makes sense, I would say don't hire a CFO early at all. I would wait years before putting a C-level kind of person in the company on pay. You can usually get by with fractional support and resources and things like that.
Yeah, and I'd say generally a bookkeeper is the person that is going to do monthly or quarterly reconciliation of your expenses and your bank accounts. Your accountant is the person that is actually going to take that information and use it to file the appropriate taxes and also talk to you about tax strategy on a quarterly or yearly basis. And then a tax lawyer is someone you need to consult if you don't understand how your company will interact with tax regulations or if you are being audited and or sued.
Oh, and the C's are just the certifications individuals need to get to do some of these roles. I did have a When I Hit on You by Fernando, which while we have still a huge chunk of people here I want to talk about, if you have more questions, obviously we're doing a little bit of lightning round here. We can answer more. But apply to Mission Control. No cost. We give a free office hours session for anybody. And office hours is basically this, but for 60 minutes. No presentation. We just help out with all these questions and way beyond. So check it out. I'll throw the link in there too while you pull up the next question, Pete.
Cool. And I think last one is from Manish. If you are a co-founding team and you know that you are going to need a third co-founder, or even a, you know, very specific individual contributor that is going to have a large impact on the business, yes, you should leave some room. Generally, we say that the original co-founding team should issue themselves between 60% and 80% of the total authorized shares and leave a buffer of 20 to 40 for your missing co-founder, your early team member, advisors, contractors, and maybe even to carve out your first equity incentive plan or option plan. So yes, it's always a good idea to have a buffer of unissued shares for those people. All right. I think that is it.
Excellent.
Thanks everybody for being here, bearing with us last week and showing up
Yes.
to the one where we were actually on time. Very much appreciated. We will circulate the recording and the deck. If you do have additional questions, come find us at Mission Control. If you are looking to onboard to a corporate management solution, even if you incorporate it elsewhere, you can email us at launch plus onboarding at gus.com. We'll include that address in the follow-up too. And thanks for coming.
Thanks a lot, Pete. Sorry I got ahead of my slides, but have a great week, everyone. We'll see you at the next one.